Market crashes can be terrifying for investors. The sudden drop in stock prices can lead to panic and rash decisions. However, history has shown that market crashes can also present incredible opportunities for those who know how to navigate them. One of the most successful investors, Peter Lynch, has shared invaluable wisdom on this topic. In this video, we'll explore how to make millions in a market crash by following Lynch's principles. Imagine turning a financial disaster into a gold mine. Market crashes, often viewed with fear and anxiety, can actually be the perfect storm for creating wealth. As Peter Lynch famously said, "The real key to making money in stocks is not to get scared out of them." This mindset is crucial when facing a market downturn. In this guide, we'll delve into Lynch's strategies to help you not only survive, but thrive during a market crash. Step 1. Stay calm and avoid panic selling. The first and most important step during a market crash is to stay calm. Panic selling is a common reaction, but it often leads to significant losses. Lynch advises, everyone has the brain power to follow the stock market. If you made it through 5th grade math, you can do it. Trust your research and the fundamentals of the companies you've invested in. When the market crashes, the natural instinct is to sell and cut losses. However, this is usually the worst time to sell. Instead, remember that market downturns are temporary. Historically, markets have always recovered and continued to grow over the long term. Step 2. Look for bargain opportunities. Market crashes can be a great time to buy high-quality stocks at a discount. Lynch once said, "In this business, if you're good, you're right 6 times out of 10. You're never going to be right 9 times out of 10. During a crash, even the stocks of solid, profitable companies can become undervalued. This creates a prime opportunity for savvy investors to pick up these stocks at a bargain price. Identify companies with strong fundamentals that are temporarily undervalued due to market conditions. Look for businesses with a solid track record, strong balance sheets, and competitive advantages. These companies are more likely to bounce back when the market recovers. Step 3. Focus on long-term growth. Lynch emphasized the importance of long-term investing. He noted, "The stock market really isn't a casino unless you treat it like one." When you invest with a long-term perspective, short-term market fluctuations become less significant. Instead of trying to time the market, focus on the long-term growth potential of your investments. Consider sectors that are poised for growth in the future, even if they are currently out of favor. For example, technology, healthcare, and renewable energy are sectors that have shown consistent growth over time. Investing in these areas during a downturn can lead to substantial gains in the long run. Step 4. Diversify your portfolio. Diversification is a key strategy for managing risk, especially during a market crash. Lynch advised, "Know what you own and know why you own it." By spreading your investments across different sectors and asset classes, you can reduce the impact of a downturn in any single area. Ensure your portfolio includes a mix of stocks, bonds, and other assets. This way, when one sector experiences a downturn, other parts of your portfolio can help offset the losses. Diversification not only protects your investments, but also positions you to take advantage of growth in various areas. Step 5. Keep an eye on economic indicators. Understanding economic indicators can help you make informed decisions during a market crash. Lynch believed in doing thorough research and staying informed about market trends. Pay attention to indicators such as interest rates, inflation, and employment data. These can provide insights into the overall health of the economy and help you identify potential turning points. Additionally, stay updated on news and developments related to the companies you've invested in. Earnings reports, management changes, and industry trends can all impact stock performance. By staying informed, you can make more strategic investment decisions. Step 6. Be patient and disciplined. Patience and discipline are essential traits for successful investing. Lynch once remarked, "The typical big winner in the Lynch portfolio generally takes 3 to 10 years to play out." This highlights the importance of sticking to your investment strategy and not getting swayed by short-term market movements. Avoid the temptation to frequently check your portfolio or make impulsive trades. Instead, set clear investment goals and stick to your plan. Over time, disciplined investing is more likely to yield positive results. Market crashes are inevitable, but they don't have to spell disaster for your investments. By following Peter Lynch's principles, you can turn these challenging times into opportunities for significant gains. Remember, the key is to stay calm, look for bargains, focus on long-term growth, diversify, stay informed, and remain patient. As Lynch wisely put it, investing without research is like playing stud poker and never looking at the cards. Arm yourself with knowledge, stay disciplined, and you too can make millions in a market crash. Start today and let the wisdom of one of the greatest investors guide you to financial success. Raise your IQ with cutting-edge info, insights, and analysis. Visit and subscribe for free at the link below.